And yeah,
Yes.
that's how I feel about finance.
Yeah. Great. Great. Great.
Yeah. So
Okay. Okay, let's go ahead.
so to start off, how did you first get into like stock trading, and what does it mean to you personally?
Okay, so stock trading, I mean, the simple answer is that it's trading of stocks. In other words, it's the buying and selling of stocks. So we have to define what stocks are. If you have one stock in a company, suppose there's a company called Philips, and they are a healthcare company, or there's a company called Facebook, and they are a tech company. One stock gives you a portion of ownership in that company. So stocks are basically, they give you ownership in the company, basically, right? They're the building blocks of the company. So the long and short of it, or the short answer of stock trading, is that it involves buying and selling company shares on a stock exchange. And there are many stock exchanges. The biggest one that we have already mentioned is the New York Stock Exchange. There's the London Stock Exchange. There's the Nikkei in Japan. Here in Southern Africa, there's the Johannesburg Stock Exchange. Here where I am, there's the Zimbabwe Stock Exchange. So an exchange is sort of the market where you can buy into a company. You can own a little piece of a company, so that ownership of the company is not confined to just the big banks like Morgan Stanley and Goldman Sachs, or very rich people, the millionaires and the billionaires. Even the ordinary person can buy a small percentage depending on how much they have paid for it. That's the long and short of it. So why do we sell? Why do we trade? When you buy and trade, you are aiming for a profit based on the fluctuations of the prices. So the price of the stock reflects the value that the market is attaching to the stock, right?
Yeah.
If the stock price is 80, it means that the consensus of the market thinks that this is how much they are worth, this is how much value they have. If the stock prices rises to be higher, from 80 to let's say 95, it means the market has seen certain good things about that stock, to say, wow, they've just, gotten some very, very big government contracts, so that's new business for them. They've made some changes in their management. Now they've put in some really experienced people. They've expanded geographically. Now they're in Canada and Mexico as well. There is something there that makes the market think that, well, we should value is higher. So that price fluctuation, if you had bought the stock at $80 and now it's 95, you can sell, and that margin, that $15 margin is the profits basically. So that's what people do. They aim to profit from price fluctuations. Let me see if there's anything that I'd written. Nasdaq, which is more commodities oriented, the New York Stock Exchange. So it helps you to participate in the growth and decline of a company, right? But it's more than just transactions, right? It goes into it's sort of a science and an art, right? You really have to be. It's an art and a science. That's why there are great investors and very poor investors. There's some legendary investors. We have certain philosophies whose strategies and thinking are very time proven, right? So it combines a little bit of economics, a little bit of math, a little bit of art, a little bit of psychology. Psychology is very big, and then just strategy and patience, right? It's kind of like playing a game of chess. I think that's what adds to the excitement of trading. So the long and short of it is that it is the trading of stocks on a market. So if you believe, for example, Mr. Elon Musk, if you believe in what he stands for, if you think that he's doing great, you can buy. If you believe in electrical vehicles, then you buy Tesla stock, right? So in summary, that's what I think, or that's what I know stock trading to be.
Why do you think stock trading is important, whether for individuals, investors, or even the broader economy?
Okay, that's a great question. The first one, we've already touched upon it. It's wealth creation, right? It gives people, including ordinary people. Let's start with ordinary people. The ordinary person who has a portfolio, maybe they've 10, 15 stocks in their portfolio. It allows them to create wealth. If you play your cards right, if you do your analysis, your thinking, and you make the right picks, then you can invest 100K, and then in 5 years, you have 350K. That's wealth generation. So it builds So there's the potential for income, right? That's at the individual level. At the corporate level, it's the way in which companies raise capital. It allows companies to raise capital through what we call an IPO. So suppose you and your brother or you and your friends were very good at programming and you build, and every teenager in America is using it and you are really growing. And then you have what we call an initial public offering. So initially your company belongs to just you and your brother and nobody else. But then it has, and Facebook actually went through this process. Eventually, you have created so much value that you can actually make the company public. So initial public offering, you are making the stocks of the company tradable on the stock exchange. That allows you to raise money because a lot of people are going to come. They think your business is sound. They're going to put in a lot of money to own a little piece of your company. So we've already talked about the benefit at the individual level. At the corporate level, it helps companies to raise money. And why do companies need to raise capital? Companies need to expand. They need to hire new people. So, for example, your app is growing. You started with 100 users. Now you have 2 million. You need to hire engineers and product designers and marketers. And where do you get the money to bring in the expertise? It is the IPO. It is selling the stock. So at the corporate level, it helps in that. It also helps with what we call market liquidity. Basically, it facilitates the buying and selling of securities, right? There's money that's circulating in the economy. So that's the long and short of it. Let me see. It does promote financial literacy and responsibility. That's something we hadn't mentioned, but it empowers ordinary people. It encourages participation in the economy from all walks of life, from all backgrounds, really.
Thank you. So question 3. Let's say someone is just getting started. So what are 3 key pieces of advice, strategies, or habits you recommend for them? Or what helped you early on?
Okay, so I will give you my answer to this. This is a very interesting, a very important question. But one thing I will say, the answer that I'm going to give you is probably limited. Because a lot of, as I mentioned, historically speaking, going back, there have been a lot of, there's a whole history to economics, to trading, international trade, to stock trading, right? So a lot of knowledge and wisdom has been passed through the generations. And as you shall see, it's important to go beyond just these few tips. You have got to learn what, the people have done in the past, those who were successful. So it's very important to read books. It's important to find sources of knowledge, especially about the past investors. Read about Warren Buffett, for example. What has made him so successful? What is his strategy? What's the underlying philosophy? You get even richer knowledge. But anyway, let's start on the strategies that I recommend to you. The first one, which I'm already talking about, is education. You've got to understand financial markets. What is the financial market? So the person who really wants to become a great analyst in the future, maybe a banker in the future, maybe an investor, maybe a hedge fund owner, must start early the process of education. You must understand very deeply. You don't just wake up one day and already you are, trading stocks and making millions. You've got to be grounded in the fundamentals of economics. So here are the things that you need to understand. What are financial markets? And you do that by trading. You have to understand trading instruments. How do you trade, right? You've got to understand the principles of management, especially risk management, because trading is very risky. You can lose money very easily. And we'll see some of the factors that make people lose money. People have lost billions on the stock market. People have lost millions. There have been market crashes in a single day. Billions of dollars worth of market cap have been wiped off collective portfolios of companies because of bad decisions. And we'll look at some of those. So education is the first one. It's important. Have that hunger for knowledge, that desire to continuously develop yourself. And for me personally, it's reading the news. You've got to read the news. I had a professor at Brown who taught us corporate finance, who made it mandatory for us to read the Wall Street Journal or the Financial Times every single day.
Yeah.
And to me that became a habit, right? There's so many cool websites out there. The Wall Street Journal, the Financial Times, read some international sources as well. And then there's a whole slew of Wall Street news blogs, TV shows, YouTube videos. They are experts and gurus whose job it is to talk about financial information. Always immerse yourself in what's happening. So education is the first one. Find your objective or your philosophy. That really helps you to know what, for example, what is my risk profile? What is my risk tolerance? Am I risk averse, or I have a stomach for risk, right? So set clear roles and define and stay grounded. Look into your philosophy because you believe in it. Be convicted in your mind, right? Another one is diversification. Well, this is very popular. This is a golden principle of investment. It really boils down to a proverb that says, do not put all your eggs in one basket. Because if you put all your eggs in one basket, if an elephant steps on your basket, then bam, you've lost everything. But if you have a basket there and a basket there and a basket there, you can lose in one basket, but the others will remain. So diversification is important. What do we mean? Spread investment across different criteria. There are asset classes. By asset classes, we mean whether it's stocks, whether it's bonds, whether it's ETFs, whether it's any tradable security, commodities, gold. I mean, across asset classes and across sectors, right? Across sectors, we mean, is it a pharmaceutical? Is it healthcare? Is it tech? What's the sort of industry, right? So you don't want to have only tech stocks, right? What if there's a
outage?
For example, in the early 2000s, there was a .com bubble that burst, and many of the tech stocks that were very highly priced basically came tumbling down, and people lost money. So if you had a little bit of a holding in tech, and then you had a little bit of pharmaceuticals, agriculture, etc., then you were it's a way of hedging your risk, right? So across asset classes, across sectors, and across geographies, right? Geographies means that the US is not the only part of the world where you can invest your money in. Eventually, when the time is right and when your resources allow, you can begin to invest in international opportunities, right? If you go to the Gulf states, you can invest in oil companies from the UAE and Saudi Arabia. You can invest in natural resources from African countries like Zimbabwe and the Democratic Republic of Congo and Ghana and Nigeria, South Africa, Kenya. You can go to Latin America and you can invest in agriculture. You can go to Asia and invest in electronics or anything where you feel justified. You do your fundamental analysis, you see that this company has value, and you invest in it. So diversification is golden. You will see it's one of the golden principles, right, of investment, of good stewardship. So that's another tip and strategy. This one is to be underlined. Research, always research, always research. Even the big firms, they have whole departments strictly on research, right? So analyze companies. We have what we call fundamental analysis. You look at a company from all angles, all sides. Does it have good management? Are they making money? You look at their financial statements. What's the balance sheets? Do they have sustainable cash flow? What's their income statement like? What results did they get in the previous 4 quarters? What's the price to earnings ratio? What's the stock price? What's the year-to-date fluctuations of that company? Remember when I told you about the process, learning the process of valuing a company or doing fundamental analysis was so mind-blowing for me because it was comprehensive. You really had to, even the news, you had to look at the news for the last month to 3 months, especially the last month. Were they in the news? Are they facing any legal trouble? What is the competition doing? Is the competition doing better? Are there threats to their business model? You want to really do your research. So analyze companies, industries, and market trends. Trends are important, right? Because the market changes constantly. It's not a static thing. Manage risk. That's the other tip and strategy. You don't want to just do things anyhow, right? And there's some techniques that you can use, like stop orders, position pricing, and portfolio rebalancing. This is just risk management, right? To prevent some rapid losses in your value in a short space of time. The other thing is discipline. Stick to your strategy. Remember, as long as you really educate yourself, as long as you do your research, as long as you really look deeply, remember, it's like playing chess. You've got to be analytical, you've got to be wise, you've got to be intelligent. It taps into your inner genius in a way. As long as you've done these things, then you are very confident and assured to stick to your strategy. And when you've stuck to your strategy, you avoid making emotional decisions. Let me check out my notes here. If decisions are not something you want to do, because if you look historically, the worst crashes, the worst losses in value that people had were out of things like greed and fear, right? So don't chase the hype, but build your conviction. And when you've locked in your conviction and belief, then, it's a mental game. Manage your emotions. Don't be emotional. Don't be afraid. Don't act out of greed, but read the news, track the data, do your analysis, and look into some philosophy. Let me see. Let me look at my notes, tips and strategies. If there's anything on my notes so if you're a beginner, I don't know if have you ever attempted something like a paper trade, like a virtual portfolio?
Oh yeah, I've had my dad he helped me open an account through him, so I've made some decisions. Yeah. So
okay, so you had a portfolio and you made some. How many stocks would you say you had in your portfolio?
Like 5 or 6, I think.
Okay, well that's a good starting point, right? Start small, paper trade first. Maybe use platforms like Investopedia. That's the one I remember. But there's a whole bunch of others that you can use. 5 or 6 is good to get the hang of it, but at the same time you are learning. So learn first and then trade later. Yeah. Oh, that's it. That's a cool mantra. Learn first, trade later, right? So you're read books like The Intelligent Investor, read up on the Wall Street Journal, read up on the biographies of investors like Warren Buffett, read up on the various markets crises that have happened, like 2008, the market crash, the stock market, rather the financial crisis of 2008, the Great Depression of the 1929, and the market crash of 1987. Just immerse yourself in this world and see what has happened historically. It helps build your understanding, right? And think of yourself as an individual thinker, right? Think of Warren Buffett. We know him as Warren Buffett. He's an institution unto himself. It's not so much his company that we remember. It's him. It's the man himself, and as he thinks, as he does it. So think of yourself. Have that self-esteem and confidence to say, I myself can do it. I worked with a student who invested through Crimson, a student who he started with a portfolio of 100K, and in about 12 months, in about a year, he had about 196. So he practically doubled his value, and he had, I think, less than 10 stocks. He made excellent picks like tech stocks. What's the name of the company? Nvidia.
Yeah,
that
Nvidia.
Makes hardware.
Very volatile.
Hardware for AI. That was one of his picks, and it had this tremendous surge. And he had a few pharmaceuticals and one, I think, oil and gas, and then the vast majority were tech stocks. And bam, in 12 months, his virtual portfolio was practically 100% up. So it's good to practice. It's good to believe in yourself, to know what your philosophy is. Even when you're making a loss, I mean, you win some, you lose some. You just have to manage your risk, right? So again, these are tips that I'm putting on the table, but remember what I said at first. You are going to need more than just the tips I gave you. You're just simply going to have to read the books. Have a library. Have your own personal library, even before you get to college, where you have just finance books. One of my favorite writers in finance is called Lewis. Okay, let me look up his name. He's the author of Moneyball, among other books. So let me look up his...
I've read the Freakonomics books? That was
Oh yes, Freakonomics is great. Freakonomics is it's a classic. I read it when I was, I think, a sophomore at Brown. It's more of a fun read than investment oriented. It just really the outlandish, interesting, strange. It's a very important read actually. Freakonomics is really good. I think I attended a lecture when the authors. It is more than one author, if I recall correctly.
Yeah, that's correct.
When they came to campus to have a talk, right? I remember it's being more than one guy, and it was packed, right? Like people were really, really interested in that. Let me see who is the author of. Let me look this up. I mean, his book was turned into a movie, so it's just one recommendation. There are 20, 30. He's called Michael Lewis, right? The Art of Winning an Unfair Game. Well, he wrote a lot of books, but he wrote Liar's Fork, Flash Boys, and Moneyball, right? So maybe you download a PDF online of his work, see Moneyball, the movie itself. He's one of the best writers I've read, and he's really a finance guy. Everything that he does is about Wall Street. It's about the various dramas, scandals, events, achievements, right? The bad and the ugly, and the good and successful as well. So build your knowledge base, have a library, have 20 books when you're still in high school that are all about finance. Find out even economic theory, right? Your Milton Keynes, your Adam Smith. You want to read a little bit at the high school level. You don't go in depth because you go in depth when you're in college, right? Yeah. Maybe you end up at Yale or Columbia or Penn or whatever school. You will do much more reading at Princeton or Brown or whatever school you go to than you would in high school. So you want that exposure and to begin to build that culture of continuous education. Okay, so as far as tips and strategies are concerned, I think, okay, there's technical analysis as well. It's not as popular as fundamental analysis. Fundamental analysis is when you dig deep into who's leading this company. Are they good? Are they making money? What are their financials? What's the market like? They've been drilling oil in Guatemala. That's great. They've been making a ton of money, but the government just changed, or rather, there's a new president in Guatemala, and he's going to reverse the policy of the previous guy. So that is an impact on their bottom line because he's going to cancel the contract, or he's not going to give them new contracts. So that impacts their business, their bottom line. So their stock value might actually go down, right? And you do know that without digging deep and sort of, reading the news and staying connected. So an analyst, for example, when you're sitting on your cubicle, working for Citibank, working for JP Morgan, you really are grounded not just in the analytical side of things, but you are really connected in what's happening in real time. You follow the news. You don't just read the news passively, you process it. What are the implications of what they're saying? You read the Economist, you come through the articles and see the opinions of the experts, right? Where might things go? For example, imagine in November, there was a new president in the White House elected, right? The previous administration was Democratic. Now we have President Trump, who is on the right side of the political spectrum. He's Republican. Yep. That has economic implications, right? Yeah. So things are not static. Things always change. Events that happen in the real world have an impact. For example, gold. Okay, do you happen to know when the gold's price goes up, what does it suggest? Then what's going on?
That means there's more uncertainty in the world, like more wars, more like, I guess people don't believe in safety. Yeah.
Yes, it's one of the safest asset classes you can buy. So if you anticipate that there might be uncertainty, right? Like right now, if you open the New York Times today, there is tension between India and Pakistan right now.
That's right.
And if there was some important mineral that was part of maybe the border between India, on the northern side of India, maybe there was some gold or some mineral or some oil or something. And now that disrupts the trade in that, there's an economic implication. So a finance guy is always grounded in the news and what's happening. So I guess we can move on just so that we don't spend too much time on this question.
I mean, the next question, we've covered a lot already. I'll just say it anyways. What are some common mistakes or risks that people should watch out for when trading stocks?
Okay. There's a lot. Things change rapidly. So risk management becomes very important, right? Because things change. unpredictably and very wildly. And some people have either, I think Mr. What's his name? There's a guy who shorted the currency of the UK, I think. He's a famous billionaire or multi-millionaire. And he made a ton of money in one day because he shorted the currency. So seismic shifts happen quite rapidly. In a single day, things can change, right? So market volatility, you want to be careful for it, right? You want to put in place the right kind of risk management techniques to make sure that you don't make any excessive losses. Liquidity challenges. Liquidity means how can you liquidate an asset? Suppose I have a phone, but I want cash for it. If it takes me 3 days to go through the bureaucracy of going to a pawn shop and getting them to buy my phone and then putting money in my bank and takes 3 business days, that's not a liquid market, right?
So like crypto,
A liquid
like
market.
meme coins and stuff.
Pardon?
So that would be like with like cryptocurrency, meme coins, like the stuff that like that non-liquid, like cryptocurrencies, like Bitcoin and stuff.
Yes.
Yeah.
Yeah, exactly. Absolutely. And meme coins and all the digital, there's a whole range, including central bank digital currencies as well, right? So liquidity is often a crunch. It can prevent you from making money. Sometimes you can fail to make a trade that would have made you money because of liquidity. So you always want to maintain your liquidity, even as a company, even if you're not on the stock exchange, maybe you're just managing your company. You want to make sure that you have enough cash flow to sustain essential or core business operations, right? Look out for company performance, right? Always have a nose for, let's call it BS, right? Poor management, poor decisions, some sort of shady legal stuff going on, some ethical shady stuff happening. Usually it doesn't end well for a company, because if the SEC, for example, finds any evidence of malpractice or unethical conduct from a company, they can be fined a lot of money. Sometimes a company can be fined tens of millions, if not hundreds of millions of dollars. And, that's a big hit on their bottom line. So you want to look out for that as well. Another thing to look out for, we've kind of touched on it, is emotional trading, right? When there's panic on the market, when the market is bearish, you don't have to be bearish yourself. You have to look at the fundamentals and look into your gut. What is your philosophy? Be resilient, be strong. If you walk with greed and say, wow, this looks enticing, when it's actually a marriage and you are deceived by it because of your greed, you actually tend to lose money. If you sell out of fear, like because somebody else is panicking, or without your own thinking, your own informed thinking and analysis, then you can sell something that you shouldn't have sold, right? You sell a stock for 50, and in 3 weeks, it's trading at 290. That's a lot of value that you've thrown down the drain because of a moment of fear. So emotional trading is one of the things that you want to look out for. Another cost from a purely economics perspective is trading costs. You must truly understand, what does it cost to make a trade? Because there are what we call agency fees, right?
Yeah.
In order to execute a trade, you often rely on human or digital second parties or intermediaries. They charge you. That's their line of business. They don't trade, they don't do anything. They execute for you or do some intermediary task. You want to understand the costs and the implications on your returns or your bottom. Yeah, I would say those are the things to look for, as well as just the complacency in not really we've connected to what's happening, right? Just kind of zoning out on what's the news, what's on the news, what's happening, what does it mean? So I would say, in summary, those are some of the things to look out for.
Yeah, okay, thank you. Also, finally, last question. So stock trading has definitely evolved over time. Have you noticed any big changes over the years in trading systems, tools, or how people approach the market in general?
Okay. Oh, hold on a second. I'm just checking on my notes here that I'd written. I think I left out something on things to look out for, so I'm just going to mention them. I'm not going to expand on them.
Okay.
There's overtrading. Overtrading can be risky, not just for the agency cost, but a lot of people make the mistake that the more trades you make, the more profits. Sometimes you're just overexposing yourself to risk. And sometimes you're just incurring more costs, agency costs that we just mentioned. So over trading is something that you want to avoid. Another thing to look out for are schemes that are called pump and dump.
Oh,
Pump and dump are influencers or popular. For example, when I was in college, one of the most popular voices on Wall Street was a guy called Jim Cramer. Okay, Jim Cramer. He was not a bad guy, but I'm just talking about the level of influence that he had, right, as an individual. There are certain people on the street, for example, or in the industry that really hype very bad stocks, right? They sell you garbage, basically. So you want to, because they're influencers or influential, you just go with the herd. You can end up losing some money. So I wanted to touch on those because I noticed that I had not mentioned that.
oh yeah, makes sense.
Okay. We can now move on to the question that you were.
Yeah. So as I was saying, like, what big changes happened over the evolution of trading, essentially?
There's quite a lot. I mean, since the modern days, we have like AI and machine learning, right? That's the in thing, and some apps for convenience. But going back, I think it was paper trade, right? Paper orders. You had to have a broker, a real human broker. The process was quite costly. You had to pay some fees for all those. Those are agency costs that we mentioned. Access was limited. It was very analog and less digital, and very, very closed off. It was not really open to the public. I feel like it was the privilege of those who had the means, who were on the upper levels of society, right? And over time, there was a movement towards digital in its various evolutions, right? I think by the 80s, a lot of markets, a lot of stock exchanges were already incorporating digital aspects. As early as 1970, that's my guess, by the way. I don't know what the exact date is, but 70s, 80s, yes. And then digital tools, as you know, like technology, like cell phones and computers, they evolve. So I think the stock market has also followed that, which takes us to today. What do we have? Today we have free apps like Robinhood and other apps. I'm forgetting the name of the other one. There's another one, right, where you can basically do some trades. And there's, of course, the new paradigm of AI and machine learning, big data. A lot of trading floors, a lot of big banks, a lot of hedge funds, they now employ PhD mathematicians, right? I remember when I was on the listserv, the graduate student listserv in my senior year at Brown, a lot of job opportunities were being posted, and they were strictly for PhD students, or rather senior PhD students in math, in physics, in very quantitative fields, computational math, computer science, data science, machine learning, AI, in order to join the firm, to join the trading floor. So that's the part. That's how things have changed. I don't know what the future holds, but I know where we are in the present. It's definitely AI and algorithmic trading, where you can really execute larger volumes of trades in just a few seconds, which was not possible back in the day, the completely old-fashioned analog era, where you needed a human broker, paper orders, limited opportunities, limited access, very high fees, right? These days, I think that's how it has changed.
You mentioned earlier about like psychologies and philosophies to the market. Like, have those changed at all, or do you think those have like remained constant?
I think there is a sort of a set of what we might call the classical or the foundational principles, even in economics itself. If you go to economic theory, I studied economics. There's classical economics, for example. There's what Adam Smith is considered one of the foundational thinkers in the field of economics. He wrote The Wealth of Nations, I think, centuries ago. The basis of what he did remains the same. So I would say, have you read A Random Walk?
Oh no.
Okay, that's one of the more classical. Let me see if I can find a link to maybe a YouTube video or an article that you can use. It's one of the classical. I think those are well grounded. So I don't think it has changed much, but I think it really differs in application or interpretation. So I would say nowadays there are more people in the field, so there are more voices of authority. Back in the day, you had very few voices and they're very authoritative, right? These days, I think there are many more younger people universities continue to churn financial professionals into the industry. A lot of them are talented, by the way. I would say of 100% of finance professionals that are churned out by the top university, maybe 15 of them are really, really talented, like top tier people who can really build value, who can build companies, who can manage huge amounts of money and do well. As opposed to, if you go back to the 60s, that wouldn't have been the case per se, right? Yeah. But in terms of the thinking and the philosophies, I don't think they have changed that much. It's really a matter of, are you a long-term investor like Warren Buffett, and you're interested in you're more patient, you are in there for the longer play, you're not interested in some quick win, yeah, basically, right? And so that's one side of it. And then there are those who are focused on a more short-term and therefore more volatile and potentially more riskier philosophy. I think the divide or the dichotomy has remained the same. So I don't see that much change. Okay, so let me look out a random walk down the streets. It was written by Burton Malkiel. Okay, let me send you the link, maybe to the Amazon link. You can find it online, maybe a PDF. It's one of the more established, old-fashioned, classical competing theories and philosophies. By the way, it's not that one is better than the others. It's really that there's a multiplicity of opinions and philosophies, and they are kind of competing. So people tend to really go with what really suits them. That's why it's very important to have your own philosophy and justify to yourself, why do you hold to it? Why do you believe in it? Once you do that, then you in every situation, right, you're well grounded in it. I'm trying to find a button for chats. I'm used to using Zoom, Google Meet, in-call messages, right? Yeah. Okay. So, a random walk down the streets. It's a classical book. You can just read an article maybe to begin with, based on the philosophy. An article that summarizes what it's about and things like that. It's one of the many more established, more old-fashioned, but still highly influential schools of thought and philosophies around the right approach to take for investing.
Well, that's all for me, Dominic. Thanks for your time. And yeah, your insights would definitely help me and others understand the opportunities and like the challenges of stock trading. So thank you.
No worries at all. I'm very happy. I'm very happy to support your journey, your curiosity. I think finance is an incredibly rewarding field. I think that you're on the right path, and you will be rewarded for your passion as long as you apply the kind of principles that we spoke about. Yeah. Mainly educating yourself, especially starting at a young age. I think that's an excellent. By the time you get to college, by the time you are a sophomore in university, you'll be a professional proper. I mean, you'll be as good as someone who can really just become an entry-level sort of analyst or an entry-level employee at a firm or a boutique firm or any company of your choice within the financial field. So education is, I would underline it as at the younger age, I would underline it as the most important thing to do. Keep yourself intellectually open. Don't just read books. Also watch movies as well. Watch YouTube videos. Talk to people. Talk to real people of the world. So whenever it's possible, whenever you're privileged to do so, to meet someone in your parents' network or whatever it is, talk to them sometimes about the serious things like what career to choose, how do I get there, how do I get into a top school. So for you, I would say the priority is to polish up your knowledge and education continuously and aim for admission in a top school. If you do that, then your education will continue in a top university. You become part of the finance society or club. You will do internships from your freshman year, sophomore year, junior year, and then afterwards, with all that experience and all that knowledge, you will most likely and almost certainly end up in the kind of career that you want. If you want to start as an analyst and then an associate, and then you sort of go up the ladder in the corporate ladder, then it will be possible. So thank you for the questions. I really enjoyed it, and all the best in your studies. If you need any further help through your tutor, of course, we can make some necessary arrangements. But for now, thank you very much. I really enjoyed it, and take care.
Same here. Thank you.
Thank you. Bye.